Hello, class, and welcome to Chapter 7, the types of investment products and how they are traded. So, in this chapter, we're getting a little bit more into the fundamentals of what type of products you will be dealing with and discussing with clients. So, an overview of this chapter, we're going to talk about mutual funds and how there are different types of investments that are held within a mutual fund. If you think about our previous definition of what a mutual fund is, a basket or a single holding that holds multiple other investments, most mutual funds typically hold a mix of fixed income or debt instruments, equities or stocks, and then derivatives. We'll talk about these in more detail going forward. Typically, when we're talking with clients, we're talking to them about the difference of fixed income and equities within a mutual fund. Some mutual funds might hold only fixed income. Some mutual funds might hold only equities or stocks. The majority or most would hold a combination of both. So, fixed income securities. What is a fixed income security? A fixed income security or investment is where an investor is lending money to the person that's issuing the fixed income. Think of it as a debt, a loan from an investor who has cash going to a company or a corporation who requires money or capital. In return for that investment, they're paid an interest, a regular interest payment, or what we call a coupon. So, again, looking down, there are typically two types of issuers, two peoples that give out or issue fixed income securities. That would be either governments or corporations. If we think about the risk that is associated to a government issued fixed income investment, the risk would be very low or virtually none, depending on what government is we're dealing with. If you think about a fixed income or a debt instrument, an investment that's issued by the government, say of Canada, the risk is extremely low to virtually none because the government of Canada is backing that investment. The only way for your investment to lose all of its value is for the government of Canada to default on payments and not make its debt payments. Corporations also issue fixed income securities. They would typically be considered a higher risk than a government fixed income security. The repayment is based on whether or not the corporation, the company, pays back its debts. Again, fixed income would be more secure or safer, all fixed income most fixed income than most equities or stocks. Typically, that's kind of how we look at the risk associated to a specific mutual fund, is how much fixed income is made up of the portfolio versus how much equity or stock makes up the portfolio of a mutual fund. So T-bills are one specific type of fixed income. They're specifically issued by the government of Canada. They're issued every 2 weeks. They're what we would consider short to very short maturity dates, meaning they come due, they're repaid within 3, 6, or 12 months. Treasury bills are also considered a zero coupon. What that means is that interest isn't paid out as an interest payment. Interest is built into the value or the price that you're paying for a T-bill. So you will buy a T-bill below its value, selling it, or it gets redeemed, bought back at its face value. And the difference between those two numbers is the actual return or interest that you earn on a treasury bill. Other types of fixed income actually receive interest payments. So again, return equals the interest income, not a capital gain. You might say, for example, buy a T-bill at $98 and it matures at $100. So that $2 difference is the interest that you have earned on that T-bill. It might seem like it is a capital gain, but it is actually considered interest if it is coming from a treasury bill. You would consider this virtually risk-free and highly liquid, again, because it is issued by the government of Canada. Some of the other key terms in this chapter that you'll need to understand. Par value. That means the face value. What is the price of a bond, which is a type of fixed income security? So the face value typically is either $100 or $1,000. So when a bond is first issued and sold, you would be buying it either for $100 or $1,000. It would then pay a coupon rate. That's the fixed interest paid to an investor for owning a bond. You might have a $100 face value bond that you've purchased with a coupon rate of 4%. And that's the interest that you are getting paid by holding the bond or loaning that money to the corporation or government. Term to maturity has to deal with the time until a bond repays its face value. So a bond might be bought. It is a 4-year bond. That means there is 4 years as term to maturity. It doesn't come due. It doesn't repaid by the corporation or the government until the maturity date. So that's considered the term to maturity. Duration. Duration has to do with the sensitivity to interest rate changes. We'll get into this a little bit more, and I have included several video links in this chapter folder. Please review those links as they'll get into some of these terms a little more detailed. But if you think of bond prices change on a daily basis, even though they are issued at face value or at par, they change in value. And duration means that a bond is sensitive to different interest rate changes. You'll learn further on in this chapter that when interest rates decline, the value of a bond goes up. So there is an inverse relationship with the direction of interest rates and the value of bonds. Yield to maturity is a term used to describe what the total return, if held to maturity, is of a bond. Again, we've already discussed this slightly, but different types of bonds, government bonds, Canada Savings Bonds are one, CSBs. That's what CSB stands for, is Canada Savings Bonds. There's no secondary market, meaning you can't go and buy or sell it. It's simply issued by the government of Canada, and then that government of Canada repays that bond. There's basically no default or interest rate risk because it's guaranteed by the government of Canada. There are marketable bonds issued by the government. They do trade on the secondary market and, again, can be bought or sold in between maturity dates. And then there are T-bills. Those are the short-term debt instruments issued by governments, and again, sold at discount, not earning an interest payment. Then we have corporate bonds. So again, fixed income securities, bonds issued by corporations or companies. Versions of corporate bonds, there are secured bonds, meaning that there is collateral. A corporation will assign assets that they own as collateral for bonds so that if the corporation defaults on paying back its bond, the asset can then be sold to pay bondholders. Then there are debentures. They are the same as secured bonds, but simply unsecured. So an unsecured version of a secured bond is called a debenture. So unsecured, they're simply based on the issuer's reputation to be able to repay its debts and to pay back bondholders. The third type of corporate bond would be a convertible bond. That is a bond that can be converted into common shares. We'll get into a little bit more detail of common shares, but if you think a convertible bond, you are a bondholder, you have lent money to a corporation, but if it is a convertible bond, there are ways that that bond could potentially be released and converted into common shares instead of being a bond or holding a bond. Other types of fixed income products that you might deal with, need to know for this course, and might deal with if you're working in a bank in the future. GICs, Guaranteed Investment Certificates. They are issued by banks, and there is a principal amount, and then there is interest that is guaranteed on top of it. CDIC insured, so Canada Deposit Insurance Corporation, is a group that was formed in order to protect depositors to banks in case of default. So with a GIC, up to a 5-year term, up to certain amounts would be covered under a CDIC insurance coverage. Guaranteed investment certificates issued by banks can be either redeemable or non-redeemable, and typically interest rates would be dependent on whether they're redeemable or not. Typically, you will get slightly higher interest rates for having a non-redeemable GIC that can't be accessed versus one that is redeemable and can be accessed. Another type of fixed income product are bankers' acceptances, BAs. That is very similar to a T-bill issued by governments, but it's issued by banks instead. It's a short-term version of a certificate. And again, just like a T-bill sold at a discount, matures at a higher amount. The difference between what you bought it and what you get it back at is your interest. Commercial paper, CPs. That is unsecured short-term debt issued by corporations, backed by a company's credit ratings and financial assets, also sold at a discount. You can think of commercial paper as being a T-bill, but instead of being issued by the government, is issued by corporations. Again, bought at a discount, sold at par. The difference between the two amounts is your interest that you've earned on that commercial paper. Bond pricing and yield concepts. So I mentioned it before, but we'll go into a little bit more. Bond prices and interest rates move inversely. They move in opposite directions. If you have purchased a bond, let's say it's at par at $1,000, you purchase $1,000 of a bond. If interest rates moving forward as you own that bond decrease, your bond will start to sell on the open market for higher than what it was worth before, higher than $1,000. It might get up to $1,005, $1,010, $1,100. Again, depending on how low interest rates continue to go. But the opposite is true as well. If you hold that same $1,000 bond, but interest rates go up, the value of that $1,000 bond will actually decrease for the time that you hold it. It might go down to $999, $990, $9,800. Sorry, $999, $990, and $980 potentially. Again, just know the value of any fixed income or bond specifically investment works in or goes in opposite directions of interest rate. So different yield calculations that you might need to understand in regards to bonds. If we talk about current yield, that is simply the annual interest rate that you're collecting from that bond divided by the current market price. What is the current rate of return on a bond? If a bond is at $100 as a market price and the annual interest rate you're getting is 5%, that means the current yield will also be 5%. When current yield changes is when the value of that bond is not at par anymore. If it goes down slightly from par, maybe your $1,000 bond, we'll go with a $100 bond. Maybe your $100 bond is now trading at $99, while a 5% coupon rate or interest payment on the original $100, if the value of the bond drops to $99, the current yield is actually higher than 5% now, because a 5% interest payment based on $100 par is now higher than 5% if the bond is trading at 99. Again, video on this attached. Please read to get a little bit more understanding. Yield to maturity differs from current yield because it takes into account time. So it's an approximation accounting for interest and price change over time. Current yield simply is a snapshot in time. What is it? Current rate of return at the current market price. Yield to maturity factors in time. How much does this price change over time? And how does that affect the yield? So if we think about a bond, if a bond is trading at a discount, that means the yield will be greater than what the coupon is listed. If your bond is trading at par, meaning it's exact same as the day that it was issued, it's $100 or $1,000 with a 5% coupon, yield and coupon will be the same. If your bond is trading at a premium, it's above its $100 or above its $1,000 starting point, the yield will actually be less than what the coupon percent is issued. Again, won't stress enough, there are videos attached to this chapter. Please view those for more details. So now we're moving on from fixed income to equities. Equity securities is simply common shares. So you might hear me say equity, you might hear me say share. They can be interchanged. So what are the characteristics of equities or shares? Well, that is simply, a share is simply just ownership of a corporation. You may receive dividends as a shareholder and potentially can have capital gains, meaning the value of those shares can potentially go up, but they can potentially go down. And there are typically voting rights. Again, typically voting rights attached to the common shares. You get the opportunity to vote on different decisions that corporation that they might make. Equities or common shares are considered higher risk than bonds, but also come with the potential for higher return. What are some of the different trading concepts of equities or common shares? So shares can be traded in the primary market. What that means is that when a share exists in the primary market, it is the first time that share is being introduced to the market. It's considered an IPO or an initial public offering is when a company for the first time decides they're going to issue ownership or issue shares to their corporation. Once they are issued and have been bought from the primary market, then they would only be bought and sold through the secondary market. It's the resale of existing shares that were first issued on the primary market. Standard trading units are 100 shares. So if you hear the term standard trading unit, that means it is a lump of 100 shares. Odd lots, when people are buying shares, if you're buying less than 100 shares at a time, it's considered an odd lot. Know those two definitions for your exam. Shareholder benefits. So again, what can a shareholder expect from purchasing common shares? They potentially can have capital appreciation, meaning the shares can go up in value. They potentially can get dividends, which, as we discussed earlier, come with favorable tax treatment. You may get voting rights. You have limited liability as well, meaning that because you own shares and you own a portion of that company, you're not personally liable for anything that that company does. You're simply liable for the value you've put in to share ownership. And marketability. Most shares can be bought and sold on an open market as long as there is demand for it. So there's marketability behind owning shares of a company. So there are two different types of shares. There are common shares, and then there are preferred shares. Most of what we discussed before this last screen was common shares. Now we're going to move on to what a preferred share is. A preferred share is different than a common share. It's a bit of a hybrid between a bond and an equity. So almost like a hybrid between fixed income and equities. There is typically a fixed dividend attached to a preferred share. There is priority over common shares if there is not enough money for dividends to be paid to both common and preferred. There are no voting rights that come with preferred shares. And preferred shares are more sensitive to interest rate changes because it is a hybrid or has many similarities of a bond. It will fluctuate in value more closely with interest rate changes. There are about four types of preferred shares you need to understand. The first being convertible. That means a preferred share is convertible, that it can be converted into common shares. Preferred shares that are considered participating, they may get additional dividends over and above the standard dividends that are paid to other preferred or other common shareholders. Cumulative preferred shares means that unpaid dividends accumulate and will eventually get paid out first to cumulative preferred shareholders. Then there are callable or redeemable preferred shares. Those are preferred shares that the issuer can repurchase before they mature. Again, not all preferred shares are these types. These are additional additives or additional features that may or may not be associated to a specific preferred share. You would know this ahead of time before purchasing. There is a preferred share valuation formula that I would recommend that you get to know, and that is P equals D over R, where P is the value of the preferred share, D is the annual dividend being paid to the preferred share, and R is the rate of return or the investor's required rate of return in order to invest in this. An example might be if you have a preferred share currently selling at $25 per share, paying an 8% dividend, that would equal $2. So D would be $2 in this equation. The market yield or the rate of return that the investor requires, if it's 10% in order for an investor to invest in this preferred share, given the formula of P equals D over R, that would be P would be $20. So the value of a preferred share would need to be $20, paying an 8% dividend, if you required a 10% return. So using that formula, if something's currently selling at $25, given you require a 10% rate of return, you shouldn't be willing to pay any more than $20 for that preferred share. So different definitions you need to know that refer to trading mechanics. So things and pieces of different orders when you would look at placing a trade or a purchase for a share or an equity. So market order is a term that simply says you're buying or selling immediately at the best price. You don't set a price for your purchase. You simply go to the market and say, whatever the current market price is, I am paying that, and your trade will close immediately. Limit order. A limit order is different from a market order, as you're going to either buy or sell only at a specific price. So you would enter a trade as a limit order. If a price doesn't get to what you've described, what you set, your trade will not go through. When we say long position in regards to equities or trades, that means you're buying first and you're selling later, meaning that a long position, you go in and buy a share today with the hopes and the plan that at a later date you'll be selling it at a profit. That's you taking a long position in a stock. Short selling is almost the opposite. Short selling is where you are making a bet or placing, or your plan is that a stock will go down in value. If you feel it's going to go down, you're going to short sell that instead of taking a long position. You're going to sell borrowed shares and then buy back later to replace that trade. So again, to take a long position in a stock, you are going to buy it now, knowing or hoping or planning that the value of the stock is going to go up. Short selling is you have a plan that the share is going to go down. So you are going to sell borrowed shares, and at a future date, once it hopefully has gone down, you're buying that back. And that difference is between what you've sold the borrowed shares and what you've bought them later at is your gain. Cash account refers to a type of account where you must have the cash available in order to place a trade. If you wish to purchase $5,000 today of TD Bank and you have a cash account, you need to have $5,000 plus any type of trading fee available in that cash account before you can make the trade. Different, a margin account is an account where you can actually place trades on borrowed money. So you're borrowing from the broker, whoever where your account is held, you're borrowing from them to invest and place trades. Underwriting is where dealers help issue securities. So a dealer might accept the contract to sell X amount of shares from a company. That's underwriting. There are two types of underwriting. One is a best effort. The other one is a bought deal. A best effort is where a company, a dealer, will accept that they have to sell shares for a company, but they're only going to do it on best effort, meaning if they sell them, great. If not, that's not their responsibility. A bought deal is where a dealer might go ahead and purchase all of what's required to be sold for a company and then go out and do it. And if they don't sell them all, they still own them. It's on their own books, their own hands. Derivatives. So again, the three types of investments we were talking about that could be held within a mutual fund: fixed income, equities, and derivatives. So we know fixed income are the safer type of investment. They are a debt to a company or cash given to a company. Company issues debt to an investor. They pay interest. It's like a loan. It's like loaning money to the company. Equities or stocks, those are common shares, preferred shares. That is ownership of the company. You are, as an investor, giving money or paying money to own a piece of the company. And then derivatives. Derivatives are simply a financial contract whose value is derived from another asset. So again, think about a derivative as simply just a piece of paper or a contract, an agreement. It is an agreement between a buyer and a seller that something will happen, something will change hands in the future. There's future prices agreed to. So there's nothing physically changing hands in a derivative. It is really just a contract or an agreement that is bought and sold. Different types of derivatives: options, warrants, rights, and futures. So an options derivative is the right to buy or sell a security, not an obligation. So someone might purchase a contract, a derivative, an options derivative, to give them the right in the future to buy or sell a security at a future price. They might do this in order to protect themselves from potential large losses, or for many other reasons, but that's a key reason. But the derivative is simply just a contract. The buyer and the seller agree money changes hand for this derivative in an options, for that person to have the right to buy or sell property, right to buy or sell a security.